Good evening.
Good evening. Shantia,
Good evening.
how you doing?
I'm good. How are you?
Good, good. I'm good, thank you.
That's good.
So you got a couple more minutes here. Give the others a chance to get on, sign on.
The prints that you asked us to print off, that's for us to do in class tonight?
We probably won't get to that tonight.
Okay.
So don't if you weren't able to print it,
I have it.
if you do it, that's good. But we'll definitely get to it. We'll definitely get to it. We'll probably do the first one, probably the net worth, but not the second one.
Okay.
So how the weekend lockdowns treating you?
I don't mind the lockdowns at all.
Okay, all right,
They don't bother me none.
that's good. That's good. I know some people, they get a little out of sorts. Only part of it that bothers me is when people start rushing to food stores or they trying to get home, to
Yeah.
beat 7 o'clock. And if you happen to still be on the road, they make some of them make some dangerous moves to try to get home.
Very true.
Yeah, but there's something maybe you'll be able to tell future generations about it.
Say again?
I said this is something we'll certainly be able to tell future generations about.
Oh, definitely. This one is for the books.
Oh, that's almost an understatement.
I don't think anybody could have foreseen this.
No. But the thing about it is we have history though. History shows us every 100 years there's a major health pandemic.
That's true. You're right.
So Okay, I have 6:01, so we might as well get started. Okay, so last class we completed looking at character, and we ended the class with net worth. Let me just go through if my screen will respond for me. Okay, there we go. Okay, so we began looking at a comparison. We started with character, and we looked at four key areas of character: KYC, employment history, credit payment history, net worth. Like I said, we ended with net worth. So the first segment was KYC. We looked at client demographics, resident stability, and there were some questions with client demographics, some questions associated with resident stability. Then we looked at employment history and tenure. And then we moved on to credit payment history. How long have they paid? How have they paid in the past? And we talked a little bit about past payment habits, that they are usually a good predictor, but sometimes there are two factors that may change that. One is that the circumstances of the good paying customer may change, and also the delinquent customer could be rehabilitated. Okay. And then we looked at some sources of credit history. We said from existing loans, whether they were banks, insurance companies, credit unions, private individuals, or in-store credit, using credit cards, life insurances, savings and other investment accounts, utility bills, equity built up in property, and school fees for tertiary education, using them also for sources of credit history. And then the last point that we got to, and actually I jumped to the net worth, and we're gonna go back to credit payment history, because there are some things on credit payment history that I omitted last week because I actually really wanted to end the class talking about net worth. So we'll go back to point 3 on credit payment history, and then we'll come back to net worth. Now, at the end of last class, I said that I would tell you the story about farmer A and farmer B. Okay, so in terms of financial institutions and the clients, there was a time when we used to focus on building client relationships. because it was, from based on studies showed that the majority of our business was derived from our existing client base. So if we treated our existing client base well, we shouldn't find ourselves having to work too hard and going out on the field trying to drum up new business. And but over the years, things have changed. Shareholders have gotten more greedy in terms of they want more. They want profits higher, and so as a result, they have increased quotas, whether they are loan quotas or deposit quotas or whatever other major delinquency. Bringing down delinquency is another quota that has gotten attention in the last decade or two. And so that has forced us to hit the pavement and try to get business from other sources of income, because what has happened is that we have basically milked our cows, so to speak, and our cows are finding themselves financially strapped, so that they aren't able to really qualify for loans. And so what we've done then is we've then, instead of teaching our clients to become savers and investors, we've basically forced them into being more consumers and to just keep acquiring loans. And the ways in which we have done that is that we have extended the terms of the loans. So instead of your normal 3 or 5 or 7 year loans for consumer loans, we now have consumer loans 10 or more years. And we have mortgages, instead of being 15 and 20 years, we have mortgages now 25 and 30 years. And we've had to extend the term or the length of the time that people can pay back, because they just did not have the income to level to service those debts. So by stretching the payments over a longer period of time, we brought the payments down, which made it more affordable. Okay. What we also did was we raised the debt servicing ceiling, and I think you may recall me mentioning this before. I remember when I first started out in Barclays Bank in the late 70s, early 80s. The total debt service ratio was 28%. I'm sorry, it was 38%. Then it went to 40. Then it went to 42. Now it's at 45, and we have exceptions where they're 50 and sometimes even 55%. So what we've done is we've extended the term, we've lengthened the time it takes for our clients to pay off the debt, and we've also increased the debt servicing ceiling. So it means that more and more of their disposable income is going toward paying off debt. And unfortunately, it is not going towards good debt. It's going towards consumer debt. Okay. So that caused me to bring the analogy about the farmer A and farmer B, the bad farmer and the good farmer. And so the farmer A, who's the bad farmer, what he does is that he doesn't feed his cattle well, and he works them and he works them and he overworks them. And so eventually, at some point in time, after they've peaked in terms of their production with milk and otherwise, they end up dying. And so when they die, now he has to get a new set of cattle. So his cost. And he buys those cattle at whatever the market rate is at that time. And so let's say, for example, if he initially bought his cows at $100 a head, he may find in the market that he now has to buy them at $200 a head. So he's putting himself, at a disadvantage already, at a disadvantage expense, because if he had taken care of his cows, he would not be having to now buy a new set of cattle at a higher price, at the market price. In addition to that, he finds himself having to pay someone to take these dead carcasses away from his site. Okay, so in addition to, he thinks he's saving money by not properly taking care of them and not properly feeding them, and getting them the medicine and stuff they need. So he figures, when these cows are dead, I'll just get a new set, and that's his mindset. And sadly, it seems as though that is, it appears to me that is the kind of thinking that some of our financial institutions have from top down. That if this customer can't borrow no more, we just could go and find new customers. Okay, but at what price is that costing the financial institution? Because at some point in time, you're not going to have anyone else to be able to who you can turn to get business. Because if you keep getting new customers and getting new customers and getting new customers, at some point in time the customer pool is going to dwindle. And so what is happening even now is that really we are fighting among ourselves for each other's customers. So we'll pay off, Bay Street Bank customer loan, and then Bay Street Bank will pay off our customer loan, and then Shirley Street Bank will pay off Bay Street, and the cycle just goes around and around and around. And it comes to a point where, and it will come to a point where those customers will not be able to borrow anymore, because we are not training those customers, we're not teaching those customers on proper investment and savings habits and techniques. It seems as though we have abandoned that to some extent. Now, on the other hand, you have farmer B, who's a good farmer. So farmer B takes care of his cattle, he takes care of his cows, right? Make sure that they get their medicine and they have top grade feed and whatever it is. And so what happens is those cows do not get malnutrition, they do not die early. In fact, those cows now reproduce, and so they give him calves. So they give him his next generation of cattle. So he doesn't have to go out and buy cattle. Okay. In addition to that, when the existing cattle become too old to reproduce milk or reproduce calves, what he does is he then sells his cattle to meat houses. Okay, so people will buy the butcher shops will buy his own cattle and slaughter them and produce meat for public consumption. Okay, so whereas on the one hand, farmer A's cattle, they die before they can reproduce. Farmer B's cattle can reproduce. Farmer A has to buy new cattle. Farmer B doesn't have to buy new cattle. Farmer A has to pay people to come and dispose of his carcasses. Farmer A, people pay him to come and take the cattle that have lost their useful life and can only be used now for butchered purposes for food. So that is the difference between farmer A and farmer B. And again, the analogy that I bring to the banks is that if we take good care of our clients, we will find that those clients will in turn bring in new clients, even if it's not their children or grandchildren. They may bring in siblings, they may bring in their friends. So we will find that we don't have to go and spend a lot of money on advertisements to bring in new clients. We don't have to have our staff hitting the payments before hours or after hours or during work hours or on weekends and having to pay them extra money to try to drum up our new business. Okay, we will find that the business will come to us, and it's all a matter of how we treat our cattle, and in our instance, our clients. And so, excuse me, my reason for mentioning this story about Farmer A and Farmer B is to try to kindle in your mind that somehow, we need to look at our existing client base, and we need to farm our existing client base. We need to treat them well. We need to look to see, for example, those who have loans that are significantly reduced, and then encourage them to come and get additional loans for worthwhile purposes. Okay, whether it's for education, it might be for health. Okay, it may be for investment purposes to buy a lot. And you may say, well, this person will never really be able to own their home when you look on the face of it. But if they are still fairly young, if they're still fairly young, and I would say, mid up to the mid 30s, they're still fairly young. There may be and they don't have real estate. They may be able to purchase a undeveloped piece of property, and they can flip that property after a certain period of time. If the value of the property goes up in that subdivision, they can flip that property. So let's say they buy a property for $80,000. It may go up to $120,000 in the amount of 2 or 3 years. So they would make about a $40,000, $40,000 profit on flipping that property. That then gives them the ability now to afford a more expensive property that can then, they can then be looking at probably getting, say, an investment property that I can put in a duplex or triplex. Or they may start off with just one unit for themselves and then add on their own to duplex or triplex. But there are ways of helping our clients, even those who are financially stretched now, to slowly climb out of the hole that one, they have dug for themselves, and we as financial institutions have helped them dig as well. Okay, so now is the time really for us to really rethink what our position is, particularly as it relates to loans, because I was thinking the other day, and I mentioned this to another banker who also happens to be a family member, and we were talking about banking, and I said to them, I said, how are y'all dealing with assessing customers in this COVID environment? Because for 4 or more months of this year, some people have not been working. Okay, or are you now narrowing it down to saying we're now only going to deal with government employees, salaried employees, because so far those are the only people who have not been affected? Or we look at the wider scope of things and say, okay, well, I see this particular business didn't let its people go. They kept them on salary even though they were shut down. So now we will say we lend to businesses like that, plus we lend to government. But then again, we're making an already small pot even smaller. So, we really, as a financial sector, really have to look hard, particularly in this COVID environment, because it's going to be with us for at least another, some people say 18 to 24 months. So we're looking at another 10 to 14 months, if not, a little longer. So we really need to re-examine how we are doing our banking operations. What is driving us, and are we really helping the public by doing what we're doing? It cannot be business as usual. It simply cannot be business as usual. Okay. Anyone has any comments or any questions?
No.
I heard one person said no.
No.
Okay. So let's go back to point number 3, which is credit histories. I think that's on page 29. Yes, page 29. Okay. I want us to look at, you won't have this actually in your book. And it's normally a handout, but I have it printed on the screen, so we'll go through it on the screen. And really, I'm now going to talk about how financial institutions record the payment history or the late payment history. And in preparation for this, what I want you to do is I want you to go to, I think it's pages 101 and 102. And yeah. Look at pages 101, 102, and 103. Keep your fingers there because we're gonna look at the rules. We're gonna be looking at their bank statements because they have a consumer loan there, they have a mortgage loan there. So we'll be looking at them in a moment. So let's look at how banks record. So it says here, all banks record the number and frequency of late payments for each client in its database. This information is displayed in the loan summary section for each account. And can be seen when requests for loan printouts have been requested and provided. Okay. So all banks, in terms of payment histories or delinquent histories or late payment histories, they record it one way or the other. Okay, and in a few minutes we'll look at the rules, statements. Banks may display the late payment or delinquency information in different ways and may start counting delinquency from different thresholds. Okay, so for example, some banks start counting the late payments from the 3rd day, some from the 6th day, and some from the 11th day. Okay, in fact, some 1 or 2 banks probably even start counting from the 1st day. Okay. The information may be displayed as numbered cycles, and where each cycle represents a specified period, or they may be shown using the specified delinquency period. And the 2 examples given here as a numbered cycle is Commonwealth Bank, and the other one using specified delinquent periods is Scotiabank Limited. So let's just take a look. I'll bring that up on your screen. Okay, so we see on the top of the screen, the chart. It says it has a bank. There's a column for the bank, and then there's the other column that says late payment delinquency history buckets or cycles. And so we'll see that Commonwealth Bank, unless they've changed their system since 2006, but they had what they call cycle 1, cycle 2, cycle 3, cycle 4, cycle 5, and cycle 6. And what I did was I went and I did the corresponding periods in terms of days. Because remember we said that sometimes they start from the 3rd day, the 6th day, or the 11th day, right? Counting when a payment is late, okay? So their cycle 1 covers any loan that where the payment is late between 6 and 14 days, okay? Cycle 2 covers any payment that is 15 days late to 29 days. Cycle 3 covers the period 30 days to 59. Cycle 4, 60 to 89. Cycle 5, 90 to 79. And cycle 6, 180 days plus, okay? Then to the very bottom, when we look at Scotiabank Limited, in comparison, we see that they, whereas Commonwealth Bank has 6 different buckets or cycles, Scotiabank basically has 4, okay? But it covers the same time span. So, for example, if you compare theirs to Commonwealth Bank, their first cycle or their first bin or their first bucket covers cycles 1 and 2 of Commonwealth Bank. So 11 to 30 days basically covers cycles 1 and cycle 2 for Commonwealth Bank. Then you see the next 2 buckets or the next 2 cycles or bins, what you want to call them, are pretty even. So there's 31 to 60 days, 61 to 90 days, and then it's like Scotiabank combines cycles 5 and 6, where they have 91 days plus. Okay, so anything that's 91 days and over. So they basically have 4. If you look just above it at Royal Bank is very similar to Scotiabank. However, the Royal Bank billing buckets, again, unless they've changed the system since this information was obtained, they start from 1 day. Okay, so 1 day to 30 days, then they go 31 to 59 days, 60 to 89 days, and then unlike Scotiabank, they split theirs into 2, 90 to 79 and 80, 180 plus. So their last 4 buckets are similar to Commonwealth Banks. And then you can look at some of the other financial institutions. Fidelity, and again, unless they have changed theirs, Fidelity has the most, or had up into 2006, had the most late payment cycles or buckets. Okay, so you see they had 5 to 9 days, 10 to 14 days, 15 to 29 days, 30 to 59, and then all the way over to the last one, 180 days plus. Now, what you'll find is that there is some similarities among these banks in terms of in terms of accounting for delinquency. So, for example, basically, most of them, their first 1 or 2 periods would end at 29 or 30 days. And then the next cycle will begin either 30 or 31 days. And then the next one will begin 60 days or 61 days. And then the next stage will be 90 days. Now, for central bank reporting purposes, they basically go 1 to 29 days, 30 to 59 days, 60 to 89 days, and 90 days and over. So there are basically four categories that central bank reporting historically on delinquencies. So that is why you'll find that while some of the systems, they may vary from financial institution to financial institution, those financial institutions can still satisfy the central bank's reporting requirements in terms of their loan category. So 129 days, 30 to 59 days, 60 to 89 days, and 90 plus days. Okay. Any questions on that?
No, sir.
No? Okay. So let's look at Martin and Sherry rule. So let's go to page 102. Page 102. Okay, and I'll bring them up on the screen. Okay. So the first one we're looking at is their consumer or their personal loan statement. Okay. Now, some banks have, you know, a more than one screen for the loan. So, and you know, again, it varies from financial institution to financial institution. So, for some institutions, they may just very basic to the loan amount, the payoff amount, the interest rate, the term, the maturity date. It may show the collateral security. And then on the following page is where they may show the late payment history. Okay. So as a loan officer, when you are requesting your client to bring in a copy of their their bank statement for their loan account or their mortgage account, you need to ensure that you let them know that you also need, if the payment history or late payment history or delinquency history is not on the front page, you also need that second page. So you need pages 1 and pages 2. Okay, so there are several financial institutions where it's already on one page, but not every financial institution does it like that. Again, because financial institutions, they use different systems or different platforms, so there will be some variation. Okay, so we can see from this loan statement that it tells us the loan type, that is an automobile, and it's a new. Okay, it gives us a customer name. So this appears to be only in Martin's name, not Martin and Sherry Roll's name. Okay, the loan date goes back to 2 years ago. The original, if you look at the left column, you see the original loan amount was $23,450. The current loan amount, and this is the principal balance, okay? The current loan amount is $16,162. It has accrued interest. That means from it has accrued interest of $31. And if you look to the right, you'll see something that says INT ACCR to date. You all see that? Interest accrued to date, February 4th.
Yeah.
Okay. So what that is saying is that $31 is the interest that is accrued to date. So since the beginning, since the last payment to the date of printing of this statement, $31 worth of interest has accrued. Okay, we see that going back to that left-hand column, late fees outstanding. There are no late fees outstanding. Okay, and then we see an amount that says total amount due or payoff amount. So what will happen is if you add the current loan amount of $16,162 plus the interest accrued, and if there were any late fees, you add any outstanding late fees, those three would give you the total payoff amount. That's understood?
Okay.
Okay, good. Then underneath that, you see it says monthly payment O/S, monthly payment outstanding. It has nothing there, which means that there's no delinquency, there's no monthly payment that is outstanding. Okay. Then underneath that, it says monthly payment due. So the payment due is $530. And if you were to flip over to the narrative on page 101, and you go down to the second paragraph, the third line, but the ending of the second line, on an RBC car loan on which they are paying $530 monthly. Okay, so that's where that $530 comes from. Okay, so they're paying on this car loan $530. Okay, the original term for this loan, it is stated in months, and most loans will state it in terms of months. Okay, so the original term is 60 months. The number of payments that were made were 24 payments, and the payments that remain are 36. So if we add 24 and 36, that should come to 60. Okay, if it doesn't come to 60, something is out of whack. Okay, someone may have been tinkering with the system in the back office somewhere. Okay, and then the final section that says collateral security description, and you see that they're holding a 2014 Toyota Camry sedan. Okay, and then if we go to the right, just above that, you'll see something saying CURR, collateral security value, so current collateral security value. And then just above that, it says original collateral security value. So what that is telling us is that the original collateral security value, the original value of this car was $30,000. And then underneath that, it says the current collateral security value, the car is now valued at $24,300. So let's go back up to where it says interest accrued to date, where we said it was February the 4th, 2016. There's a column that says late fees paid. There's nothing in there, so that means that there are no late fees outstanding and no late fees were paid. Okay, so far this loan is looking good. The payoff date, you're looking at February the 4th, 2016, which is the same as the accrued to date. So if you were to pay this loan off to date, what they're saying is that you'd have to pay that $16,193. Okay. It tells you when the last payment date was. So the last payment date was January the 31st. Okay. So if the last payment was January the 31st, and we have accrued interest, it means that interest is accrued from February the 1st, 2nd, 3rd, and 4th. Okay, so the $31 should be the equivalent of 4 days interest at 12.75%. And at the very top, you'll see original interest rate, 12.75%, and the current interest rate is 12.75%. Okay. The next payment due date is February 29th, 2016. And the maturity date is January 31st, 2019. Okay. So, so if we look at those dates, basically what is happening is the last payment date was on the 31st of January. It matures on the 31st of January, 2019, 3 years later. Okay. In 36 months. And you'll see if you go back over to the left where it says number of payments remaining, 36. So there's some correlation between where it says the number of payments remaining and the maturity date. So those are some of the things you'll quickly look at the loan statement to make sure that everything is in order. So it looks like this person's payment date is the 31st monthly, or at least the last day of the month, with February 29th being a leap year, apparently. Okay. So that's good. Any questions on that?
No.
So far, so good.
Okay. So having done that, let's look at the late payment history down to the bottom. Okay. So we see that they are their late payment cycles or buckets or bins, whatever they want to call it, start at 1 to 30 days. Then they have another one, 31 to 59 days. Then the third one is 60 to 89 days, 90 to 179, and then 180 days and over. Now you see some zeros under each one of those. Anyone knows or want to guess what those zeros mean?
Meaning that they don't have any late payment days?
They don't have any late payment days. Exactly. Very good. So this loan has operated for 2 years without a late payment. Now there could be a reason for that. The people could be good payers, as well as it could be by salary deduction. So if salary deduction was done properly from the inception, there wouldn't be any hiccups. So this is showing a perfect payment history. Okay. Now let's look at the mortgage for these clients. So now we're looking at the mortgage. The mortgage account, and it says mortgage conventional residential. Okay. Basically what that means is that this is a owner-occupied residence, single-family residence, basically. Okay, so normally, banks will, they'll say what type of mortgage it is. Basically, they'll say, if it's a consumer loan, personal loan, or if it's a mortgage or whatever it is, and then it'll say what it is. So, for an example of the consumer loan, they said it was an auto loan, and it was a new. It was for a new car. Okay, it wasn't for a used car. Okay, so this mortgage is conventional residential or single family owner occupied. The customer, this is in both Martin and Sherry Roll's names, and the loan goes back 16 years. The mortgage goes back 16 years. So they took this mortgage out 16 years ago. And going through the statement at the left side first, originally they borrowed $132,000. The current loan amount is $76,935. Accrued interest is $86. And we see that, again, that this is accrued to February the 4th, 2016. There are no late fees outstanding, and there are no late fees paid. The total amount due, or the payoff amount, is $77,021, which is when you add the current loan amount, or the principal loan amount balance, and the accrued interest, you get $77,021. Okay. The monthly payment outstanding, there's no monthly payment outstanding, and the last payment date was January the 31st. So just 4 days prior, there was a payment. The monthly payment amount due is $975. And if you look at page 101, the second paragraph, you'll see among the roles, fixed expenses are a mortgage at RBC Finco taken out 16 years ago over their residence in Eastwood, on which they are paying $975 monthly. Okay, so the information that we received from the client corresponds with their bank statement, which says it was obtained 16 years ago. and the monthly payment is $975.
Hello?
Hello? Did you lose me just now?
Yeah, just for
Okay.
a second.
Okay. So I was saying that if you went back, flip back to page 101, the second paragraph, you see that among the roles, fixed expenses are a mortgage at Royal Bank, Finco, RBC Finco, taken out 16 years ago over their residence in Eastwood, on which they are paying $975 monthly. So you'll see that information that the client provided you pans out with the mortgage loan statement. So it says that this loan was issued 16 years ago and they're paying $975 a month. And then if you look down, the collateral security is over a property in Eastwood Estates, okay? So there's no monthly payment amount outstanding. And again, the last payment was made on the 31st of January. The original term is 300. Okay, the 300 months, of which they've made 192 payments. And when you subtract that from the 300, they have 108 payments remaining. Okay, and as mentioned, the collateral security description is given there. It's lot number 34, block 5, Eastwood Estates, New Providence. You go back to the top on the right, the interest rate is, original interest rate was 7.5%. The current interest rate is still the same. Okay, we already talked about the accrued to date. There are no late fees that were paid, no outstanding. The payoff date, again, if they wanted to pay this mortgage off, they would have to give you $77,021. The last payment date was January the 31st, just 4 days prior. The next payment due date is February 29th. The maturity date is January the 31st, 2025. And the original collateral security value, or the original value of the residential house, the property that they live in, was $155,000. And you'll see that the current collateral security value is $275,000. Now, when you look at the consumer loan, the car loan, and you look at the original value, what can you tell me? Let's go back to that. The original value started off at $30,000 and is now $24,300. So it is lower, but on the mortgage, it is higher. Anyone wants to guess or say what they think may have caused the car, the value of the car to go down as opposed to going up?
I don't know.
You say
I'm thinking.
you say the value of the car went down and the value of the mortgage goes up?
Whereas the value of the house went up. What could have contributed to the value of the car going down?
I guess wear and
Well,
tear, accident.
You could say
Yeah.
Sorry, so someone said something else. I forgot. I didn't get that.
It's the date when the car,
mileage.
how old the car is,
Mileage.
How old the car is? Depreciation.
depreciation, right?
Depreciation. That is the main factor. Depreciation.
But Mr. Nordage, can't you say there's depreciation on the house as well?
We can get that in a minute.
Yes.
Okay. But but consumer durables like cars, computers, furniture, those kind of things. The value of those, they depreciate. Very seldom do they appreciate. Okay. Now the difference where they may appreciate is like if with a car is if you have an antique and you restore that antique, and so you may have bought it for $6,000. You restored it and it's now worth $30,000. But that's an exception. okay? But in the normal scope of things, consumer durables such as automobiles, furniture, they depreciate over a period of time. You know, equipment, machinery in a business, okay? I don't know if you've heard it, but some people say, as soon as you drive that new car off the lot, it's lost
Right. The
10%
value
of its value.
appreciates.
It depreciates. So depreciation is what really has driven this driven this car down. And I think basically you're looking at between 10, on average, you look between 10 and 20% per year. Because some insurance companies, they depreciate a car over a 5-year period. Say the car's useful life is 5 years. Some will say 7, and so they may use 15%. Some may say longer, and they may use 10%. Okay, and at the end of it, they arrive at something at the end of the 5 years or 7 years or whatever the period is. They arrive at something called a salvageable value, what the car is worth at the end of all the depreciation. Okay, so now that takes us to the residence. Okay, and we see that their residence is worth more, about $120,000 more than when they first got it. And while a house does depreciate, there are two things that can cause a house value to or a real estate property to appreciate, particularly buildings. If you properly maintain a building and do renovations, you'll find that you would improve the value of the building. You would either maintain it or improve it. Okay, so for example, let's say that I bought a house $100,000. You know, the floors are carpeted. You know, I got the sheetrock ceilings. You know, the regular Formica over the the plywood for my kitchen cabinets. But then 6 months into owning the house, I got the cabinets, and I upgraded the cabinets where I now have Korean top, you know, cupboards, you know, custom made cupboards. I've taken the ceiling down. I have tongue and groove, wood, you know, nicely stained ceilings. I've taken up the carpet. I've put down marble tiles. I've changed my windows from the regular awning windows. I put the hurricane-proof windows. I've upgraded the air conditioning. So when you look at the sum total of what I've done, right? I may have even put in solar, you know, solar panels. So that could add about $20,000 to $30,000 value to my house. So my $100,000 house, you know, I now find that is now worth $130,000. Okay. So in addition to the directly investing into the property and improving it, or even adding on an extension. So for example, if that $100,000 house was a 2-bedroom and I add on an actual bedroom and bath, you know, that'll probably take it up about another $18,000 to $20,000. Okay, so I can improve it by the quality of the stuff that I put into it, as well as by adding on to it. Okay. The other thing that causes appreciation is when you find that land values, the value of the land itself is appreciating because of demand, and also because of things that are happening in the area. So for example, before Bahama project was announced, let's say that you could have gotten a home, you could have gotten you know, relatively decent home out west for about $450,000. Okay, once they announced Bahama and then cutting off what they call it, Skyline Drive, and and some of the other areas, making them gated communities, and Bahama development went up. A lot of those properties, that $450,000 house, all of a sudden went up to $550,000. Okay, so because of developments in the area, you can cause real estate prices to go up. So the three ways that I'm aware of is, one, you improving the contents, the fixtures in the home, like I mentioned about the cabinets, etc. Adding on to the property, to the structure, or the area itself is being upgraded or developed, improved developments. Now the converse can happen as well. So if let's say, for example, now let's say Bahama flops, and that whole Bahama thing now becomes a derelict, abandoned hotel, you'll find that real estate prices will fall significantly in the area. Okay, so the reverse could also occur. Okay, but what it's showing us here is that something has happened to cause the Rolls house to appreciate in value as much as $120,000 over a 16-year period. Okay, so from 16 years when they got this mortgage to now, this house is appreciated by $120,000. Okay, and it's almost almost doubled in value, almost 80-90%. Okay, any questions on that explanation before we look at the payment history?
No, sir.
Okay.
I just have a but it could go in terms of the mortgage, it could go the other way as well, right? Because you're saying the house value can appreciate, it could also depreciate as well.
Yes. So if these people neglected the house, or there was an adverse development, because if any of you know anything about Eastwood, right across the street from Eastwood is Elizabeth Estates,
Yeah.
which is a government low-cost housing development. Okay, but even in Elizabeth Estates, you'll find that a lot of people are improving their homes. They're adding on, and you have one or two not too good a condition, but for the most part, people are improving, and so Elizabeth Estate has not had an adverse effect on Eastwood Estates, which is across the street. Okay, or at least it would appear, and we'll see that when we actually get in a later chapter, when we actually look at the full appraisal, not just the excerpt that is put here for this, but we'll be actually looking at the full appraisal that goes along with this property, and looking at it in some detail. That'll more than likely be after, but it definitely will be after the midterm break. We'll be looking at that. Okay, so and any more questions on that before I look at the late payment history on this?
You say you're gonna look at the
late payment history on the mortgage.
Okay then.
Okay, so we see late payment history, and actually when we look at the consumer loan, only had one level of late payment history, but when we look at the mortgage, the mortgage has two, right? So it says late payment history overall and late payment history YTD. Anyone want to guess what that YTD stands for?
Yeah, today.
Year to date. Okay, so some of you all know a little bit of accounting. Great stuff. Okay, so it first of all gives us the late payment history overall, which means it's telling us what the payment history on this account has been from 16 years ago to now. And then it is telling us what the payment history has been for the last 12 months. Okay, so year to date, the last 12 months. So if we look, we'll see that the first they count the first payment as being late from day 3. Okay, so it's 3 to 14 days, 15 to 29 days, and so on to 180 plus days. So we see that from 3 to 14 days, there were 5 instances of a monthly payment being late. 15 to 29, 5 as well. 30 to 59, there are 3 payments, 3 instances where payments were late. 60, 89, 1 payment, 1 instance where 1 payment was late. None in 90 to 79, and none in 180 and over. Okay. So what question I want to ask is this. Do you think that that's a bad history, bearing in mind that this is 16 years?
Before I
Not really.
before I answer it, right?
No,
When you say they say it 3 to 14 years, it's saying it being late 5 times 3 to 14 years. They talking about per month or
Yeah, it's
it's just over there?
5 instances where,
Uh-huh.
where a payment was late in that category. So let's say
That's a total of
let's say
14 months in total
January.
then. Mm-hmm.
Let's say January they had a payment that was late 3 days, and it went all the way to 14 days, and then it went over 14 days all the way up to 29 days,
Mm-hmm.
and then it may have slipped into 30 to 59, and then into 60 to 80, 89. Then you had a second one that also went from 3 to 14 and 15 to 29 and 30 to 59, but it did not go any further than 59 days. Then you had a third one that went 30 to 14 days
Okay.
late, into the 15 to 29, and into the 30 to 59 again, but not higher than that. So that accounts for 3 of those payments. So then you have 2 more payments, 2 more different months that went later than 14 days, but not later than 29 days.
Okay, so that's a total of 5, 10, 13, 14 months total then.
No, just
They were late? No?
5, just 5 months worth of payments.
Oh, it'll just be 5.
Because we had 5 payments that was 13 to 14. Well, 5 of them went up to 29. Only 3 of those 5 went up to 15 and 59. Only 1 of those 3 went as far as 89.
Okay.
Right? So that's what that's telling us. Now, when you get into 30 to 59 days, that's when another payment is due. Okay? And when you get into 60 to 89, that's when a third payment is due. So when you see something 60 to 89 days, an account is what they call a default. So this account went 2 payments late 3 times and 3 payments late 1 time, which means they went into default 1 time, which means that the bank could have called in this loan. Anytime a payment or part thereof, those 3 payments in arrears, you can call the loan. And that I'm not saying that that's what happened in this instance, because, well, it obviously didn't, because you know, 16 years later, they still have it, and the last 12 months they've had a perfect payment history. Okay.
I don't think it's a bad payment history. I mean, things has happened. This person might have lost a job within those couple of months and was maybe struggling to meet the payments. But after securing another job, they would have shown how they were making the payments on time.
Yes, yes, yes. No, this is not a bad, for 16 years, this is not bad at all.
Not at all.
This is a good, this is a pretty decent record. Notwithstanding that they have gone 30 to 59 days, 3 times, and in default at least once. Okay, again, there could be a reason for that. But you know, again, you look at the late payment year-to-date history. The last 12 months, they've not had a late payment. Okay, this bank gave these people a car loan 2 years ago. Okay, 2 years ago. Okay, so 2 years ago they had no on the car loan they had no bad history. So it would appear to me that if we look back 24 months on the mortgage, chances are 24 months ago they didn't have a late payment either. Because if these people had late payments, the bank would not have given them a car loan. It would be highly likely the bank would give them a car loan 2 years prior. Okay, and as one of you pointed out, it could be that one of them lost a job, so there was some difficulty there with servicing the loan, or there could have been something else that came up, some other family emergency. Maybe there was a medical emergency, and the funds were used on a medical emergency. I mean, you don't know. Okay, we're not told that. Okay, we're not told that in the write-up on our front page. So but if this was an actual client, we would have that kind of history background on the client, and so we'd be able to tell. Okay. All right. Now keep your fingers on page 101 to 103, because what we're going to look at next is we're going to look at Martin and Sherry Rule's net void statement. But before I do that, I just want to do a quick refresh on what we ended with last class about the net void statement. Okay. So any questions on this before I move on to the net void statement?
No.
No. Okay. Good. Okay. So you recall the last week, the bottom of page 29, it says net worth refers to a client's pool of assets less their liabilities. They should have equivalent of at least 3 months' expenses invested in liquid assets for emergency. A good net worth indicates ability to save or pay down loan debt. Then we said some questions to ask. Where does net worth come from? Does it come from real estate, invested savings, or something else? There was a fill in the blank. Is net worth reasonable for the client's age and lifestyle? And I think I said I talked a little bit about that as well, because we last week we talked about the individual who basically only had a vehicle and no real tangible assets, and so their net worth and I think they had worked for a number of years, quite a number of years. And so we were saying that, either they weren't financially responsible, or it could be that, they were starting all over because of some life event, some tragedy or divorce or whatever it is. And I promised that we would look at another one. And I'll do that once we finish looking at the Rose net worth statement. Okay, has net worth been increasing or decreasing? How liquid is this net worth? Has the person built a liquid fund to weather any unexpected emergencies? Okay, so what I want us to do is to again look at Martin and Sherry rule, their net worth statement, and we're going to do it together. So we're going to start with the assets. Okay, so take about 2 minutes and read through the write-up where it says Martin and Sherry rule, ages 40 and 37, and scan through it and see what assets they have. I'll just give you a hint. There aren't many assets given to us in this write-up. And some of the assets they do have, the values of those assets, you may have to find them in the bank statements when we look at the collateral security description. Okay, so just a couple hints there. So 2 minutes, look at that and read through that, look through it, and then we'll go through it together.
Sorry, Mr. Knowledge, what page is the write-up on?
That would be on page 101.
'Cause
That starts the case study, Martin and Sherry rule. I think it goes all the way to page 105 or something like that. So, but I think we only need to look at pages 101, 102, and 103 for this exercise.
Okay. Thank you.
Okay. Anybody needs any additional time?
No.
Okay, so let's go through this. So let's start with the assets. Okay, and then we'll look at the liabilities. So, are we told of any cash holdings that they have?
No.
Okay, so
No.
we don't know. Okay. Are we told of any stocks or bonds?
No.
No.
Okay. Are we told about any accounts receivable?
No.
No.
Are we told about any cash surrender values of any life insurance policies?
No.
No.
Are we told about any real estate that they own?
Yes.
Only in the house.
The house, okay.
Yes, the
And
mortgage.
what is the value? What is the value of that house?
The value of the house is
275. The car value.
175.
275,000. Yes.
Yes.
Okay. Do they have any automobiles?
Yes.
Yes.
Okay. Do we know the value of that?
24,000.
24,300.
24,300. Okay. Alrighty. Do they have any other assets?
Do we consider the bonuses?
The bonus wouldn't be,
Okay, so no.
and it would not be considered an accounts receivable either, because bonuses aren't guaranteed unless,
Okay.
of course, they were told that we are declaring a bonus, and you're going to get that in, say, 1 or 2 or 3 months. So, for
Okay.
example, so like if okay, so so apart from that, they, as far as we're aware, they have no other assets. We don't know of any. They may have them, but we're not
No.
told, right? Okay, so their total assets are 299. Pardon?
Mr. Norridge,
Yes, ma'am.
let me ask something. In reference to the bonuses, right? You could let me know if this is the right area for that. So how come I've seen where lenders have taken the bonus into consideration when it came to qualifying? So that's something different.
We're gonna talk about that in the next segment about
Okay.
bonuses.
Okay.
Okay. So so for the statement of affairs, we don't, like I said, unless of course we know that this is something that normally happens.
Yes.
Like say in the instance of a like lawyers and that kind of thing.
Okay. Thank you.
Partners or whatnot. You wouldn't normally put it in accounts receivable. Okay. But there are exceptions, and we'll get into that when we look at the next segment. When you look at ability. Okay. So I hope you have your calculators, or you can use your cell phones. I'll allow you to use your cell phones. But come the midterm and the final exam, you won't be able to use your cell phones as your calculator. You'll have to have a regular calculator to do the calculations. Okay, because cell phones are not allowed in the exam. All right. So and I'll provide a couple handheld calculators for those who may not have on the night of the midterm and the final exam. Okay, so Don't try to go and buy one if you don't have to. All right.
Mr. Nottage,
So yes, ma'am.
sorry. Can you go back? I'm trying to pick up this real estate at 275. Where are we getting this information from?
Okay, we're getting that from. Okay, you see the loan statement on the screen, and you see it on your page. I think it's 103. There's something that says CURR, COLL, SEC value, current collateral
Okay.
security
I don't know
value.
why I was looking at 101. So that one comes from the actual loan statement 103.
Right,
Okay.
and that's why I said you're gonna have to look at page 101.
Okay.
You have to look at the
Yeah.
write-up and the two
I
loan
saw it.
statements to get the information.
Thank you.
All right. So and sometimes I deliberately did that in this exercise because sometimes that's what you have to do in order to get because sometimes customers will give you, they'll say, man, that car I bought that for $30,000. That car weighed $29,000. Okay. And the thing about it is most insurance companies don't say what the current value of the car is. Okay. Some of them do put it on the estimated value of the current value of the car, but most don't. Okay. And so you need to have something that will give you a fair guideline, and in your own mind, if a car was bought for $30,000, ain't no way that could still be 2 years later that's still worth almost $30,000. Ain't no way, because if I had to buy a car and someone would sell a used car for $29,000, I would look for going and buying it brand new one time. Just pay $1,000 more and get it brand new one time. Okay, so that's where we got that from.
Are you going to then, for a car situation similar to the bonus situation, is there somewhat, because every bank is different. So for a car that we know it's past 10 years old, or it's 15 years old or some sort, what will we be able to calculate? Are you going to show us that as well?
There is a I forgot that there's a blue book, right? I think it's called the blue book on car values, right? So so if someone comes and they tell you they have a 2013 Kia Rio, worth $16,000, you would look in your blue book, and also you could look at you can look at the newspaper ads on Facebook, see what similar cars are being sold for. You could check with your supervisor and your colleagues, say, you all really think this worth such and such and such. So then you may have to do an adjustment. So when the client gives you a figure, if it doesn't sound realistic, during the interview you may want to do a quick check then, and when I was doing loans, we didn't have social media, so I can go on Facebook and look for things for sale and stuff like that, right? So now you could look on Marketplace and stuff, and they have hundreds of cars on there for sale, and you look at what the average prices are, and so you don't even have to go to your blue book or your red book, or if you have a relationship with the insurance company, you can just call your friend at the insurance company. Hey, how much do you think such and such a car is worth? I have a 2016 Buick LeSabre. How would you all put the book value on that? So there are ways of finding out. Okay, so it's not an exact science, but you have tools at your exposure, you have information at your exposure, you have people at your at hand that you could get information from. I hope that helps, right?
It helps. My other question is, though, if we have this example, on the exam and there's no obviously blue book or internet accessible, what will you advise one to do if there is a car, a vehicle that is questioned and we have to provide the amount or value of that vehicle if it's very-
Chances are, the asset you would be given, somewhere you would be given the value of the asset. So like in this instance, the value of the asset was in the loan statement. It'll either be in the descriptive paragraph, the overall write-up, or it'll be on the bank statement or somewhere. I don't want those two places. It won't be hidden from you. There won't be any new surprises. It'll either be in the write-up or it'll be on the loan statement. Okay, I'm gonna, you're not gonna have any of those kind of blind sides coming at you. All right.
So, Mr. Nottage, could you refresh my memory, please? I'm looking at the real estate amount, which is 275,000. Where did we get the figure from, please?
Okay.
Because I'm looking at the original loan, which is 132,000, which is both Sherry and Martin.
Okay.
With Martin only has original loan, which is 23,000. I'm not seeing where the total amount comes from, 175,000.
Okay. Look to the column on the mortgage statement, to the column on the right, to the very bottom, collateral security value, 275,000.
Oh, that, okay.
Okay. So it's telling you what the current collateral security value is.
Thank you.
Remember, we just talked a little bit about why it appreciated, why the value went up as opposed to going down.
Right, okay. Thank
Okay.
you.
All right. Great stuff. Good stuff. If you're not sure, this is the time to ask the questions because, I don't know if any of you are lending officers or seasoned lending officers or in banking at all. So ask away at your questions. That's the only way you're gonna get a hold of it. So I'm glad for the questions. Very good. Wonderful.
Okay, since we're asking questions, can you go over the late payment history again,
The
please?
late payment history? Okay.
Yeah.
All right. Well, let me do this. Let me finish this net weight statement, and then I'll go back to
Okay.
the late payment. Okay.
Thank you.
So we know that we have we are told that they have a house, a real estate, and they have automobile. Now they may have cash in the bank and other assets. They may have cash surrender value, life insurance, and any of those other things, but we are not told those things. Okay. So for example, if let me see, is this the one? Yeah. So Sherry works for Domino's as a shift manager. I don't know if they still do, but there was a time when the managers used to get bonuses at Domino's. Okay. They were fairly regular, and they were fairly reliable. Okay. But it doesn't say here that she she has so much being declared, so we can't use it as an accounts receivable. Okay, so again, the only two that we actually have solid figures for are the real estate and the auto, and when we add those two together, we get 299,300. And if any of you all add it up and get anything different, let me know, please. And if not, we will look at the liabilities.
Mr. Nottage, sorry,
Okay.
you're saying for the
Yes, ma'am.
bonuses, we are not going to list the bonuses under the other category if there are bonuses given, even though she's giving like, I guess, a estimated value of what to expect. It's not a real value, or
Okay, she gets a bonus of 9,000 a year. Okay, But we see now, if we were told that, let's say it said that of that $9,000, right? Let's say it said she expects to get $3,000 bonus next month. Okay, if that was stated in here, right, as part of our $9,000 bonus, she is expected to get $3,000 of that next month. Then we would have put that in accounts receivable. No one would know about Domino's, that it was pretty pretty guaranteed. Okay.
Plenty pizzas.
All right. So if it isn't stated there, don't guesstimate. Okay. But you'll see where the bonus, when we get to ability, you'll see where the bonus will factor when we take into consideration doing their service ratios. So these are two different things: the net worth statement and the calculation of their ability to meet debts. They're two different things. We use some of the same figures, okay, and some of the same information, but slightly different. Okay, the net worth statement is telling us something different from the debt service calculations. Okay, it'll probably get a little clearer once we do the debt servicing. Okay.
And what about the
But in this
insurance?
instance,
Sorry, what about the insurance? What if one say I have an insurance that's valued at $150,000? Will you put the value of the life insurance in there if they had a life insurance, or
no, not the life not the life insurance. You put the cash surrender value. So they may have, and we're going to have an example where we're going to that was supposed to be the second the second one, this one on Benjamin Bain, which we may or may not get to do tonight. That depends. But the cash surrender value, you do not put the face value of the policy. Okay, so while someone may have $150,000 worth of life insurance, they may only have, say, $10,000 of that $10,000 cash surrender value. So what we want is what we could actually put our hand on. So if we had to surrender that life insurance, what would we get apart from death? Okay, apart from death. Okay, because the only way we get 150,000 is if that person dies. Okay, but as long as they're living, what is the amount that we can get for that policy now if we were to cash it in? And so it would be that cash surrender value. In this instance, I'm given, say, $10,000. So if in that instance, then we would have put the $10,000 in there. And like I said, they may have life insurance policy and they may have cash surrender values, but we're not given that information. So we can only put in the information that we have. Okay. In this instance, but in a real life situation, we would be able to get that information from the client.
Mr. Nod, you could go back to the other screen, please, where you show the collateral cash, whatever value, the 275,000.
That one there, yeah?
No, yes. So the current collateral's value, can we assume that that is always real estate? Because I see you had it in the prior screen under real estate, 275,000.
Yeah,
is that always? It's always real estate. No, what I'm saying is it cannot include maybe, let's say, I don't know, whatever it is. It's just always real estate all the time.
Well, in this instance, you see the collateral security description says that their house is located on lot 34, block 5, Eastwood Estates. Okay, so that is where this real estate is, and that real estate is worth $275,000 based on the most current appraisal.
I just wanted to make sure that that is always what it says, and it may not be additionally something else later on. I don't know. I'm just wondering if it always is real estate. Okay.
Real estate will only be real estate.
No.
You can only put real estate figures in real estate. If they had two properties, let's say they had another property worth 40,000, then you would have added the 275 and the 40,000 together and get you 315,000.
Right.
And so in real estate, then it would show a total of 315,000 as opposed to 275 because they have two pieces of real estate.
That's
But
understandable.
somewhere else you would indicate where they have two pieces of property.
And see, in the prior
go ahead.
screen, you have real estate, which is understandable. But here you have current collateral secure value, which does not say real estate. You
Yeah, but
understand
this
what
is
I'm
a
saying?
mortgage. But this is a
So-
mortgage. And mortgages are only secured by real estate.
All right.
Okay.
Okay. So now I know this is
the
only real estate.
residents, so vacant lots, okay, vacant lots, developed lots with houses or duplexes or condominiums or businesses, all of that is real estate.
Okay.
Okay. Now we're
Alright.
going to be looking at a chapter that talks about the different types of collateral security, and we spend a lot of time on real estate. Like I said, we will be looking at an appraisal. Actually, the appraisal that goes along with this case study. Okay, so it says current collateral security value. If you look at the consumer loan, it also says current collateral security value, because we may have taken a term deposit. Okay, so collateral security description would have been term deposit number so and so in the name of so and so. Okay, so what you find is that the people who do these programs, they have to put a generic stuff there, which is why collateral security. What is the collateral security? The collateral security is this: a 2014 Toyota Camry. So it tells you what the collateral security is. Okay, so it's almost like any other kind of statements or applications that you may fill out, and they may ask you, where do you live, right? I live on Market Street. Do you own where you live? Yes or no? Okay. And that way they know, okay, well, this person now owns, the property when they live. Or you say no, is it owned by family or are you renting? You see, so different applications and different information forms. For example, when the customers come into the bank to even open up a deposit account, there's certain questions that are asked, so you can determine, certain things about that client. So one question may help to qualify the other question. And so in this instance, on the loan statement, it is qualifying what the collateral security is. Okay, because what they want is they want a space to show the value of the item that is securing the loan. So what is the value of the item that is securing this consumer loan? The value is $24,300. And what is that item? That item is a 2014 Camry sedan, or is a fixed deposit, with $110,000. But of that, we only hold in 24,300. Okay, so we only need to. We only need. Sorry, whatever the original loan amount was, 23,450. Okay. Okay, so so we have they own real estate, which is the house they live in, and they own at least one automobile that we're aware of, and so we do our total. So it's 299,300. Okay, now we go to the liability side. We can eliminate rent because they're not paying rent because they have a mortgage. Okay. The next one, do they have any credit cards?
Yes.
Two,
Do they have one or more credit cards?
They have
They have
two.
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 So
And what is the total of those credit cards?
You want the total or the balance?
72.
The balance, the total balance.
The total balance.
2,445.
$2,445, yes,
Yes.
which is the first one on which they owe $2,395, and the second one in which they owe $50. Because see now it's saying amount owing.
Mhm.
Okay, now some statement of affairs or net worth statements may have next to the credit cards what are the limits. So so you can have an idea of the limits. So you may and the reason for that is they want to compare. They want to see are these people how close they are to the limit, or are they over the limit. So for example, if they had if their total limit was $1,500, right? If their total limits were $1,500 between the two credit cards, but they have total balance outstanding of $2,445, that is telling us that they are over
Over their
one of those
limits.
limits or more. Okay, but we see their combined limits are 4,000 and 3,200, which is 7,200. So their combined limits are 7,200. So they are well under their limits. And in one, they hardly owe anything on it, $50. Okay. Now, do they have a consumer loan or a personal loan?
Sorry,
Yes.
no, let's go
Yes.
back
Yes,
a
we know they
second.
do. Sorry.
Let's go back a second to the credit card.
Okay.
Why are we not using 5% based on the balance?
5%. Why you want to use 5%?
No, I'm asking because when I went back in my notes and it gave a demonstration on page, it says to use 5% of their limit.
For calculating debt service ratios.
That's
Not for
okay,
net
so
worth.
just for that. Okay, all right. So now I
Okay.
see. So this is once again
Okay.
different from, yeah.
Great. Okay. So we want to know the amount. See to the top there it says amount owing. We want to know the amount that they owe.
Mhm.
So the amount that they're owing would be the outstanding balances.
Correct.
Okay. So the net worth shows us what they own less what they owe.
No. Mhm.
Okay. So if we keep that in mind, that should help quite a bit. What they own less what they owe.
Mm.
Okay. So right now on those cards, they owe collectively between the two of those cards $2,445. Okay. Is that helps? That clear it up?
Yeah.
Yeah.
Okay.
Going ahead
Very
and-
good. Okay. So okay, so let's go to consumer loan. You said yes, we have a consumer loan, and that consumer loan is on the car. What is the amount owing, the principal amount owing on that car?
16,193.
Let me just get my paper. Okay, that is the total amount owing. Okay, what we want is the current loan amount, the principal balance. We don't want the interest.
16,162.
Because remember now, this interest is accruing, right?
Oh,
So,
okay.
so by the time, let's say this statement is dated February the 4th, but they may not come to us until February the 10th. So that accrued interest would be more than $31. So right now we want to know the principal amount outstanding. Because other than that, then we have to go and calculate another 6 days worth of accrued interest. And I don't see where the bank would want you to do that. Now, some financial institutions, that might be what they want, okay? But generally speaking, you want to put in that principal or that current loan amount, which is 16,162. Okay?
Okay.
And is the reason I gave clearly understood why?
No, explain why you're not adding the interest to that. I just want to know.
Okay, the reason we're not adding that is this interest is accrued up to February the 4th. Okay? This person may not come to you for the loan until February the 10th, which is 6 days later. So if we're gonna do the payoff amount, then you're gonna have to calculate an additional 6 days of accrued interest.
So
And the
am
whole
I,
point is to, sorry.
sorry, am I assume this accrued interest is not the same as per diem? You know, like how some banks have per diem.
Well, the per diem is well, if you divide this by the 4 days, that'll give you what the per diem is. Okay, but the accrued interest is the per diem multiplied by the number of days that have already elapsed. In this instance, 4 days have already elapsed.
Okay.
Okay, so 4 times whatever the per diem is gave us $31 on the consumer loan. Okay, now if you think in terms of accounting, in accounting, when we're looking at assets and liabilities, we do not include accrued interest when we do in liabilities. Okay, you're looking at principal balances. There's going to be some notes or some other statement that's going to state that the payoff balance is such and such, which includes such and such amount accrued interest. That's a totally different statement. But for your assets and liabilities statement, right? What you want to do is your net worth statement. You just are dealing. You're dealing with principal lump sum amounts. Okay, so it follows very similar to accounting established and standard guidelines. So, for example, when we look at the assets, you'll see that we are starting with the most liquid assets. Okay, so we can start with cash, then go stocks and bonds, accounts receivables, life insurance, cash and surrender values, real estate. Then we're looking at auto and other. Okay, on the liability side, again, we're looking at rent expense, credit cards, consumer loans, mortgages, other. Okay, so it's following very similar to established standard accounting practices. And in standard accounting practices, you deal with the principal sum, not the outstanding balance, which would include some interest. Okay. I hope that helps to.
Yeah.
Okay. So we know they have a consumer loan, and so we said we're looking for the current loan amount, which is what now?
16,162.
I heard somebody, but I didn't hear clearly. Pardon?
16,162.
16,162.
Right, 16,162. Okay. Do they have a mortgage? Yes.
Yeah.
Yes.
They
Okay.
do.
And what would be the amount owing?
What amount?
76.
76,935.
Exactly, the principal amount 76935. Okay. Now there's some other the 3 others there. are we told of any other liabilities?
No.
No, we know when we're not told of any other
No.
liabilities. So let's add up what we have. So we add up our liabilities, and our liabilities should come up to 95,542. Anybody got anything different?
No.
Okay. So
Yeah.
and what we do is we then move that over to where it says less total liabilities under the total asset. You see that?
Hold on.
Okay, so we in order to get our net worth, we now have to subtract the 95,542 from the 299,300. So we put that in that less total liabilities section. Everyone sees that?
Mhm.
Yes.
Okay. And what does that give you?
203,758.
3,758.
Exactly. Okay. So 203,758. Okay. Is there anyone who the item that I sent today, is there anybody who didn't get to print it out?
Yes, I didn't get to print
I
it out.
wrote it down.
Okay, you didn't get to print it out. Okay. All right. What I will do then is okay. I'll do that one next week. I'll do that one next week. Because that one, particularly on the asset side, is quite comprehensive. It's quite comprehensive. And I don't want to attempt that. Because if you don't have it printed out, it means you can't read it. And I didn't print out. I didn't put the narrative on the screen. Okay, so we'll do that. We'll do that one next week. Okay, we'll do that next week.
Okay.
Okay. All righty. So let's
It's not it.
yes, ma'am.
When there is, like how in this example, we can actually see the printout of the customer information. I guess my question is, if on the exam, hypothetically speaking, you give us a printout similar to what we're looking at now, a case study.
Yes, on the final exam, on the final exam, there is one very similar to Martin and Sherry rule. And if all goes well, you'll have one on the midterm, which will help you prepare you. Let's see. Your midterm is what, the 28th?
28th, but then we have restrictions, say 7 p.m. and not a minute after. So I know what we could do.
Sorry, was that?
So we have a restriction saying we have to be on by 7 p.m.
Curfew.
Oh, that's right. Yep. Okay. Okay, all righty. Oh yeah.
Yeah.
Oh yeah. Okay. Anyway, let me make a note of that.
That one threw you for a loophole, Mr. Knowledge.
curfew on night. Yes, yes.
Now, you
My- my-
forget about the curfew. Wait, Mr. Donald, you sound like you was partying too.
No, man. I can't afford to. Citizen. Curfew on night of exam. Okay, let me. I have to get with. I have to get together with this staff, and we're gonna have to think of something.
Yeah, a midterm as well. Midterm
That's right.
and final.
This goes until the end of October. It goes until the end of October. Oh boy.
I guess the
Alright.
test would have to be taken in the daytime then.
Yeah, I guess.
Speaking of there's the curfew.
Yeah, we let me discuss it with the with the institute, because what probably would happen is, see, all as far as I know of, all of the banks are members of the institute.
Exactly.
And so HR, your HR department may give consideration to allowing you to get off earlier to accommodate it. So, but we're gonna work something out. Okay, we're gonna work something out. Alrighty. So I'll just get together with the BIS staff, and okay, and we'll work something out. Okay. So yeah. So because what I wanted to do. You let the cat out of the bag. Because what I was going to do is I was going to, your last homework, I was going to give you a mock exam to do the weekend before the, a mock exam to do the weekend before the exam. And then you could submit the mock exam to me. And if there are any areas that you're having problems on, you know, I could address them with you individually, get you on the right track. Yeah, but it's just that with all this now, it's causing me to let the cat out of the bag. I was supposed to let you know what the mock exam until next week. But it doesn't hurt. It doesn't hurt to know that you may have a mock midterm. So, all righty, well, okay. So next week we will definitely look at. We have to come back to and deal with Benjamin Smith. That's his name. Yeah. Okay. He's going to Bahama Bank tomorrow. We'll deal with Benjamin Smith next time. Okay. So someone had a question before I go on to ability. Someone had a question and wanted me to go back. I told him. Someone had a question on late payment history. Okay, so the person who had a question on late payment history, go ahead and ask your question, please.
Yes.
Hello.
Hi.
The student who said they had a question on wanted me to go back over the late payment history. Someone said they
Yes,
had.
can you explain the 5, 5, 3, and 1 again, please?
Okay, sure, no problem. Okay, so this particular one, they start counting. So let's say, for example, this person had a payment that was 1 day or 2 day late. Okay, but it didn't go 3 days late. Then that would not show. Okay,
Right.
this one starts at 3 days. So on the third day, if the payment is still late, okay, on the third day, if the payment is still late, it would begin to show. So this person had 5 payments, 5 separate payments at different times that went late 3 or more days. Okay, so it went 3 up to 14 days. Then those 5 payments went later than 14 days, so they went into the 15 to 29 day category. 3 of those 5 payments went into the 30 to 59 day. And one of those 3 went into the 60 to 89 days.
Oh, oh,
Which
okay. Okay, I got it. Thank you.
got it? Okay, great
Yes,
stuff.
I got it. Thank
Okay.
you.
So even if you're not a loan officer, or going to be one eventually, even for your own personal benefit, to read your own loan statement if you ever get a loan, it's good to know that information. Okay. Okay, so let's skip Benjamin Bain. Oops. Okay. All right. So let's move on to, with the exception of us having to come back to do Benjamin Bain, and also talk about. I'll talk about the remember we were talking about the net worth when the person has more than than what they, let's say they've been working three years and they got like $1 million worth of assets. Okay, I'll do that next week along with Benjamin Bain. Okay, and that'll wrap up character and the network section of the network section of character. But before I end, so far we've been looking at net worth where the net worth is positive. Okay, so for Martin and Sherry Roll, we see that their net worth was positive, and that's because their assets exceeded their liabilities. Now, if the liabilities are more than the assets, then the net worth will be negative. Okay, and that's pretty much frowned upon by financial institutions if you have a negative net worth. Okay, so let's look at ability. Okay, and it says here, next to character, ability is probably the most important component of credit assessment we are considering. If it is clear that the client cannot pay, then the decision should be to decline the loan. Okay. So we look at character. They have good character. Fine. We now look at ability, right? The second letter in compare, ability. And if it doesn't matter how much collateral security they have or how good they paid in the past, if doing this loan for them, they are not going to have the ability to pay this loan, then don't proceed with the loan. Okay, and so that's what we're going to be looking at. Okay. So in dealing with ability, we look at 2 aspects. In particular, we look at debt servicing and total debt service ratios. That's what TDSR stands for, total debt service ratios. Okay, and we also look at income confirmation and how we calculate those, whether the income is weekly, whether it's annual, and the different types, salary income, bonus, rent income, whatever. Okay, investment income. All right. So in the book, I'm going to go in reverse here. In the book on page 30, in the book, it starts off talking about total debt service, and then it talks about gross debt service, and then it talks about consumer debt service. I'm going to go in reverse because it might be easier. So when I rewrite this book, I'll do it in reverse as opposed to starting with total debt service ratio. I'll treat it like it's an equation. So there are three debt service ratios. There's consumer debt service ratio, there's a gross debt service ratio, and there's the total debt service ratio. And we're going to talk about each of those right now. Okay. So the consumer debt service ratio is the total monthly consumer debt payment as a percentage of your monthly income. Okay. And your consumer debt payments consist of credit cards and consumer loans or personal loans. Okay. So credit cards and personal loans, those are your consumer debt service items. Okay. And it's noted here that they should not exceed 10% of your monthly income. Well, that's a big joke because most people, their consumer debt service ratio is around 45%. Okay. And as we go through this, you'll see why I made the statement I made earlier about us in the financial services industry and how we have put our customers in an unfortunate situation because of our greed for profits and continuing to increase the profits and make more money, make more profits. Okay, hence the story about farmer A and farmer B. Okay, but there's really no real way. If you look at Bahamian debt and the Bahamian way of doing banking, that consumer debt is only 10% of a person's monthly income. That's as far as we could possibly see. While that is what it should be, that's kind of like a pipe dream that you could find someone whose consumer debt is only 10% of their monthly income. So as a result of that, very seldom do you hear people talking about consumer debt service ratio. Okay. You find them talking about the other two, gross debt service ratio, which is the housing ratio, and the total debt service ratio. Okay. But very little do you hear about the consumer debt service ratio nowadays. Okay. The gross debt service ratio, as I indicated, is the total monthly housing or mortgage payment as a percentage of your income. So if you're paying rent, that is included in your gross debt service ratio. If you're paying a mortgage, that is included in your gross debt service ratio. So you're either paying rent or you're paying a mortgage when you're considering the gross debt service ratio. Now, why they call it the gross debt service ratio, do not ask me that. I do not know. If it was left up to me, I would call it the HDSR, standing for housing. Because in housing, or I would call it the RDSR, the residential debt service ratio. Because under housing or residential, it would encompass rent as well as a mortgage payment. So again, I don't know how they arrived. I could probably do a study on it, but it is what it is. So your rent or your mortgage payment is referred to as your gross debt service ratio. Okay, and that should not exceed 35% of your monthly income. Okay, so whatever you're paying for housing, whether by mortgage or rent, should not exceed 35% of your income. All right. And the third point was already mentioned. So the third one is your total debt service ratio. Okay. Your total debt service ratio is, as it implies, it is your total monthly payment obligations. That should not exceed 45% of your monthly income. Okay. And that consists of consumer loans and credit cards, which is a CDSR, and the mortgage or rent lease payments, which is your GDSR. So if we were to give it an equation, you would say TDSR equals CDSR plus GDSR. Okay, so TDSR being 45%, CDSR, I have it reversed. Sorry about that, my bad. CDSR, that should be 10%, and GDSR should be 35%. Okay, that's reversed. I'll correct that. I'll correct that when I send the PowerPoint presentation to you guys. Okay, so 45, 10, and 35. Okay. And again, like I said, very seldom do you hear about CDSR and to some extent GDS. You don't hear about GDSR if it's a mortgage. They'll talk about that. Nowadays, if you're dealing with a consumer loan, it's total debt service ratio, and they're looking at 45%, which is why people have 45% of their income, sometimes 55% of their income going towards consumer loans or personal loans, which, you can see there's a vast difference between 45% and 10%. Okay. But how do we calculate the gross debt service ratio? Okay. So it's the proposed or the actual mortgage loan monthly payment divided by your gross or gross monthly income multiplied by 100 would give you a percentage. So as you can see from the example below, if someone's proposed or actual mortgage payment, or even this might have been their rent payment, is $1,025, and they make $3,750 a month. You would divide the 1,025 by the 3,750, multiply it by 100, and that'll give you a percentage. So what that 27.33 is telling us is that 1,000 is 27.3% or 33% of 3,750. So the gross debt service ratio is 27.3% or 27.3%, or if you want to round it, 27%. Okay, and the rule of rounding is if it's under 0.5, you round it down. If it's 0.5 or above, you round it up. Okay. Again, some financial institutions want you to show the exact decimal points. Some of them may want you to round it up, but be guided by whatever your financial institution requires. So similarly, when we're looking at the total debt service ratio, you're looking at the total monthly payments or obligations, which would include the new loan or the proposed loan, expressed as a percentage of the gross or gross monthly income. And so in this instance, you can see down at the bottom there, piggybacking from the previous example, where the mortgage payment was $1,025. So they have a mortgage loan of $1,025. They have a car loan payment of $325. They have a credit card payment of $150, which totals $1,500. So we take those total monthly total monthly obligations, and we divide them by $3,750, multiply it by 100, and that gives us 40%. So that is telling us that 1,500 as a percentage of the 3,750 is 40%. Okay, and that is under the 45% maximum guidelines by the central bank. So the maximum TDS is 45, and we see that in this example is 40%. Any questions on that before I move forward?
No.
Okay. So some questions to ask yourself. Looking at page 31, there's some questions to ask. with regard to debt service ratio, are the debt service ratios, that is the GDS and TDS, within our guideline for the amount and the term requested? Can the client meet this debt and total obligations? Have you verified the numbers to ensure that all is correct? That is, you have not mixed any weekly figures with monthly figures or quarterly figures, etc., or annual figures. Okay. Also, is there a debt that will be paid off very shortly, within 1 to 4 months, that would bring the debt servicing to within guideline? And we can look at that, maybe not tonight, but next week. Does the client have the necessary self-discipline? And this is for in those instances where it's not salary deduction, so you're relying upon the client to bring the money in. Okay. What stage is the borrower in their credit life or their financial life? Okay. We better look at some of these questions, but right now, given the last one, I'm going to look at that first. Okay. What is a person's credit life? Or what is a person's financial life? Okay, what life cycle? Okay. Now this is not gonna appear on the exam. Okay, this is just to enhance your learning and for your personal benefit. Okay, but there are basically 4 phases of an adult's financial life or credit life. Some people may call it. Okay, I prefer to call it the financial life. Okay, so basically, sometimes it may start earlier than 25. It may start 18, age 18. But basically, between the ages of 25 and 34, you're primarily engaged in consumer debt. That's when consumer debt is at its highest. You have college loans. If you were off to college, you may have college debt. You acquire car loans, credit cards, etc. So that's between the ages of 25 to 34. Okay. The next phase is that 35 to 44 age bracket, where your debt or your borrowing days are peaking. Okay. You take on additional debt, but this debt is more focused. So you take on debt for mortgages for, whether it's a residence or it's an investment property. This is where you acquire assets, whether they're stocks, bonds, real estate, other worthwhile assets, such as owning your own business. So you begin developing your own business. If you have children of college age, you're borrowing for their college. You have aging parents. So some of your money is going towards taking care of your aging parents, those who have not provided for themselves. So that's the 35 to 44 year bracket. Not to say that some of those things may not continue, but generally that is the peak period. Those things happen between the ages of 35 and 45, generally speaking. Okay. Then you see that we move from in being kind of in the red to moving in the blue. So the age 45 to 55 is when you should be having your debt subsiding. Loans and mortgages start to be paid off. You're more concerned with protecting your existing assets and retaining those assets, such as life insurances, probably establishing trusts, if you haven't already. Excuse me. If you haven't already established any trusts, some people may want to go the route of establishing a trust, or some other retirement fund, etc. Okay, and then you have the 55 year category above. In this category is basically, and you see it is represented by green, which means around this time you want to have minimal debt, or or have no debt. So you want to have your mortgage and loans paid off, and this is where you are utilizing those assets that you've acquired, whether it's investment properties, duplexes, condos, etc., whether it's your own business, whether you have investment accounts and you're getting your dividends from those investment accounts, or interest income from investments. Then you're looking at retirement and traveling. You probably start giving gifts to your heirs. Those those gifts will probably be in trusts. So you start releasing those trusts to the individuals, or even to charities. Some people do that while they're alive. Some people do it, they wait until, when they're passing, and then the gifts are transferred to whoever the heirs are, or charities. Some people do a bit while they're living, and some people do a bit, in their will. So some heirs and charities will get while the person is alive, and some of them will get it when they're dead. So if we look at it from a chart perspective, that's it, just given the listing it in age and color coding it. But if we look at it in terms of the chart, okay, and we see on the vertical axis, we have dollar values, and on the horizontal axis, we have the age. Okay, so so while debt could be accumulated in that, and it's not listed there, 18 to 24 year category, because some people, they don't go off to college, they start working at an early age, and so they start accumulating debt and or savings. Some people, they are fortunate, and their savings will start even when they're at birth, because their parents or someone took out life insurances or savings accounts and turn it over to them. So by the time they reach the legal age, they already have a good savings, so they may not require too much debt. But in that, you see that debt and savings or investments begin in that 18 to 24 year category. They increase in that 25 to 34 year category, as mentioned previously. It peaks in that 35, the debt, which is represented in the red line. It peaks at 35 to 45, and it begins to decline significantly in the 45 to 54 age bracket. Again, being eliminated by the time you retire at age 60, 65. Okay. Whereas the green line, which represents your savings or investments, you want that to continue increasing. Okay. So so at some point in time, you'll see that your savings and investments may be equivalent to your to the dollar value of your debt. Okay. But then afterwards, your debt reduces and your investments and savings increases. So that's basically the four phases of an adult's personal financial life. Any questions on that before we wrap up?
No.
Nope.
No.
Okay. All right. Alrighty. What I'm going to do is I'm going to look at income and DSR calculations from page 32, and we'll end with that. I'll try to wrap it up in 6 minutes or less, 5 minutes or less. Okay, so page 32, there are 2 blanks to fill in. Salary income, use 100% of the primary job for each borrower. For gratuities, tips, bonuses, use 50%. Second jobs, use 50%. Rental income, use 50%. Commission income, use the average of the last 3 to 5 years earned commission, but must not exceed current years. And we're gonna go through these next week. Okay. What I'm gonna do is I'm gonna send this whole section where the blanks are filled in. So it'll make some sense to you when you're reading it. And so when we meet next week, we should be able to go a little faster and complete ability. I want to at least complete ability for the midterm. Okay, and ability is quite a in-depth section. So character and ability, and also you'll find collateral security or insurance. Since we're dealing with comparative, the last item, you'll see that those 3, the C, the A, and the I are the most meatiest parts, because in my estimation, they are the 3 most important aspects of comparative or credit Cs. Okay, so I'm going to send the PowerPoint presentation, and like I said, it's going to include the whole section on ability with the blanks filled in. So that should assist us in moving a little ahead, and you might have some questions as a result, and so that will make it even more, make it flow even better. Okay, are there any questions before I sign off?
You get back to us, Mr. Nottage, on the outcome of your discussion with BIFs concerning the exam.
Yes, I'm going to take this up with them first thing tomorrow morning.
Okay, thank you.
Okay. We will work out something. We will work out something. To everybody's satisfaction.
Okay,
Okay.
Okay.
gotcha.
So if there are no other questions, continue your reading or reread. Go over this information again that we've covered tonight. And you might even want to look at that one with Benjamin Smith, that net worth, and see how what you can come up on your own. And you may even have more questions when we actually get to do it next week. Okie dokie. So there are no further questions or any concerns or comments. I will sign off and say la-di-da until next class. Well, you may hear from me before then. We'll definitely, I'll send the PowerPoint presentation, and you'll hear from me before next class, definitely before next class, about the challenge we have with the curfew on the midterm.
Okay.
Okay,
Gotcha.
so you'll have a good night.
Okay.
You
Good
too.
night.
Stay safe.
Bye.
Good night, everyone.
Good night.
Oh my God. Who did that? That was card 1. But there's also, let's try to vote from.